Hello and welcome to our latest Money Show Money Masters podcast segment. I'm Mike Larson, editor-in-chief at Money Show, and today I have a very special episode planned. Two of Evercore ISI's top experts are joining me to talk about the markets. Mark Mahaney is Senior Managing Director and Head of Internet Research. He's here to talk tech. And James West is Senior Managing Director and Partner, and he's going to share his thoughts on energy. Welcome to the podcast, gentlemen.
Hey, Mike.
Thanks, Mike.
Glad you could be here. Mark, I feel like I have to start with you for two reasons. And one is that you've spoken at a couple of our Money Show events over the last year and have really been spot on with your bullish outlook for some key tech sector leaders. So congrats on that. And second, early in this year, the Magnificent Seven names look to be leading the market again. So I guess I'd start with asking you, is this going to continue and why or why not, in your opinion?
Okay. Well, let me see. I want to put a little context in all this. I think last year for equity growth tech investors, I think last year was a really great opportunity. I think it's like a once in a decade opportunity. I don't expect a repeat of that this year. It was a once in a decade opportunity because of the year prior, which caused this, what I call DHQs, dislocated high quality company opportunities to exist. You had dislocated estimates, dislocated multiples. That's not the case now. Multiples came back last year. You had this dramatic outperformance because the multiples were able to come back to more normal levels. There's still one or two stocks I find particularly interesting in the large cap space where I think their multiples could go higher, but most of the other ones are what I call compounders. They go up 25% in a year because the multiple holds and their earnings go up 25%. That's kind of where I think what happens to Meta this year or Google this year. So I think the overall backdrop here. So that's the stock setup, which is it's neutral. Last year it was bullish. This year it's neutral. Then it's the question about fundamentals, and I look at the fundamentals for most of the advertising, or a lot of the advertising verticals or sectors that I track, and the trends are going to be neutral to favorable. I think in 2024. I think advertising, for example, which impacts Meta and Google, I think that growth accelerates this year because of the Olympics, because of the presidential elections, because you got easy comps at the beginning of the year, because there's a lot of product improvements, some of which are AI driven, that are really helping make digital advertising more effective, not less, more effective for marketers. So I think advertising is going to accelerate this year. I think cloud computing is going to accelerate this year, largely because we're through what's called the optimization cycle for most companies. And I think there are other areas like this. We were looking at Netflix last night that reported the entertainment subscriptions vertical, which is Netflix and Spotify. They both effectively have implemented price increases on very popular subscription businesses. And so I think you'll have acceleration and growth for those names. So I look at this and I call myself compound constructive for 2024. And I continue to I'm continuing to be positively biased on these stocks. And just to lay them out, my top picks here are Amazon for 2024, Expedia for 2024, Meta, and then my fourth one would be DoorDash.
Okay, great. We'll get back to those individual names in a minute. I appreciate that. James, let me segue over to you. I mean, as an energy specialist, you certainly have a lot to keep an eye on in this market, whether it's geopolitics, rising U.S. output, long-term demand shifts tied to the energy transition. Can you set the big picture stage right now, what you're seeing for in energy for our viewers and listeners?
Absolutely, Mike, and thanks for asking the question, because I think there are a lot of conflicting trends and a lot of myths out there in the market, and we do cover all of energy. So we cover the traditional oil and gas side, and we cover the clean energy side as well. Clean energy is very nascent. It's a growing part of the energy mix. It will be a much larger part multiple decades from now. However, oil and gas is still incredibly relevant, as 81% of energy is derived from hydrocarbons. That's down from 82% a decade ago. So you can see that the impacts that renewables are making on energy are not that large, and the whole consumption of energy continues to grow. There's 7 billion people on this planet that live in energy poverty. There's 1 billion of us that live with energy. I wouldn't call it abundance yet, but probably abundance soon. And those 7 billion would like to live more like we live, or at least in some version of how we live with access to energy resources. And for example, a father in West Africa is not going to wait for me to build him a wind farm so that he can cook dinner for his kids on a convection oven, right? So they're going to consume wood. They're going to consume dung in some cases, coal. And we are at the largest coal consumption right now we've ever seen in history. We're the largest oil consumption, largest natural gas consumption. The general trend is energy markets will continue to grow. And a lot of this growth in energy demand actually comes from Mark's coverage group because it's the tech industry, the platform companies in tech that are causing this surge in demand for cloud computing, which consumes a lot of energy. And of course, AI is expected to be some 3.5% or so of the global energy consumption by 2030. That's a big number. So you take the US, for example, electricity demand has been stagnant for almost 2 decades. It's now growing at a very rapid clip. And so as we add wind farms, as we add solar, we're still seeing growth in that. We're seeing that demand get picked up right away, and we're having all kinds of interconnection issues. And so what I think, and what we'll be talking about when we get to Las Vegas here next month is really, is energy transitioning or is energy evolving? Is it an energy revolution or evolution? I think it's more of an evolution. I think the transition over time will happen, of course, but I think that we'll be using hydrocarbons for a long period of time. And we have in the energy markets right now growth in capital spending primarily in the international markets. So think Middle East land, Middle East offshore, and in the big offshore markets of West Africa, Latin America, and Asia, whereas North America is somewhat of a market that's gone through a lot of consolidation and going kind of sideways, but in the hands of much better capitalized companies, the bigger, larger major oil companies, the bigger, larger independent operators. And really our favorite picks now are the ones where the growth is continuing, and that's going to be, of course, SLB, or what was formerly known as Schlumberger, which is the bellwether in the group. They're the most international, the technology leader in the space. And they're trading at a multiple that's below the S&P. Also, Technip FMC, or FTI, which is the major subsea equipment manufacturer. They're bidding for projects. Deliveries will occur in 29, 30, and 31. So the visibility to cycle is just enormous for the oilfield service industry. And then we also like Noble Corporation, which is an offshore driller, excellent balance sheet. They're not going to be building rigs like we've done in prior cycles and overbuild the market. Nobody's going to do that this time. I think we'll be capital disciplined, and I think a lot of that huge cash flow that's coming is going to come back to shareholders with dividends and share buybacks.
Okay, great summary there. Appreciate it. James, let me ask you a question about the application of technology to the energy industry. We're hearing so much about some of these things like carbon capture, hydrogen, clean hydrogen as a fuel, new battery tech, and so on. How does that change sort of the supply dynamic outlook? And how do you see some things unfolding there over the next few years?
Yeah, that's a great question. There's a lot of change coming to the industry. A lot of these technologies not necessarily new, but they are becoming more and more part of the energy mix and becoming more important to the energy mix. Solar, wind, battery storage, or energy storage are competitive with fossil fuels. Energy storage, of course, is the holy grail, if you will, to make fossil fuels, to make renewables non-intermittent. So the problem with wind and solar, it's not always sunny, the wind's not always blowing. But now if I can store that energy when that's not happening and release that energy, I can have 24/7 renewable energy. And so those are, I would say, energy storage is by far the fastest growing area of the industry. Hydrogen is nascent. Now, it's the most abundant element in the world. It doesn't occur on its own. It's always attached to something. So we've got to crack the hydrogen and then clean it up and then take that hydrogen and probably liquefy it or compress it before we use it to put into hard to abate industries. So industries like steel manufacturing, cement manufacturing, where we need a combustion event, but we don't want to use natural gas because that releases CO2. And then to your point on carbon capture, we've done that in the oil field for 100 years. This is nothing new for the oil field, but it's something where we've used that carbon, we put it back in reservoirs to produce more oil and gas. Now we want to capture it, store it in the reservoir, not produce more oil and gas with that, but take it out of the atmosphere. And we're talking about technologies like direct air capture as well. I would say hydrogen, carbon capture, maybe not in the economic stream right now relative to other new emerging technologies, but getting there fairly rapidly. And we've got a big government push, of course, with the IRA bill here in the U.S., the Green Industrial Plan in Europe, that's adding government incentives to that, similar to what we did for the solar industry 11, 12 years ago, and got solar from not economic to wildly economic at this point.
Yeah,
And our
right.
favorites, just to wrap that up, our
Sure.
favorites in the clean energy space have to do with really the integrators of energy storage. So Stem, which is a software provider, Fluence, which is an integrator, somewhat battery agnostic, backed by AES, the major utility that's going to become the next big green utility in the U.S., and also a company, Altus Power, which is, you can really think about them. They're thought of sometimes as a rooftop solar company for C&I businesses, but they're really, I would say, a green distributed energy utility.
Okay, great. Thank you. Mark, you talked about some of the micro drivers. I mean, everybody always talks about what growth stocks and the Fed and interest rates, but we'll leave that for another conversation. Micro drivers, it sounds like you're talking about cloud computing, advertising spend. Can you go into that a little more in depth? I know you already mentioned Amazon, and I think Expedia would be particular beneficiaries.
Well, I would. I won't completely leave the macro behind. I do think that in an environment where rates are going to be coming down, I don't know the pace of the rates coming down. I don't know the frequency with rates come down, but rates are coming down,
Yeah.
and that's good for long duration assets. It just is. So just like that was a massive headwind in 2022, it becomes. I'm not sure it's a massive tailwind, but it's a tailwind this year. So that's a we've had multiples come back to par, is what I call them, like back to average levels. I want, if something crazy happens, probably not multiples going down, undershooting. It's probably multiples overshooting, like things never work out perfectly rational. The crowd tends to move, and it doesn't always come right back evenly to par. So enough of that. In terms of these micro trends, I'll just click off a few things that I'm really excited about in our top picks. When I think about Amazon, I mean, this is three fundamental catalysts ahead of it. I think if I'm right about cloud computing growth starting to reaccelerate as we move beyond the optimization cycle, that means AWS, Amazon's web services, their cloud business, that should accelerate. That's kind of the big unlock. That's the real reason Amazon shares have done great last year, but they've really kind of been middling performance over the last 2 or 3 years because of the deceleration in AWS. You start reaccelerating it, stock can re-rate higher, multiple can go higher. Second thing is I think you're going to have record high operating margins out of the North American retail business, record high. Third, I think you're going to get record high free cash flow margins out of the company as a whole. These are all three 2024 events. So these three fundamental catalysts come together, so I think they will. The stock goes materially higher. But both of those three, the most important is that AWS revenue growth acceleration. We spin it over to Expedia. Look, this was a play off of leisure travel. So the 3 or 4 point pitch here, simple pitch here is leisure travel was pretty robust in 22, pretty robust again in 23, and we think it's going to be pretty robust again in 24. We work with Dwayne Fenningworth, our lodging and airline analyst here at Evercore, who does a phenomenal job. But all the data points suggest that leisure travel demand isn't dropping, is not deteriorating, is not declining. And then secondly, it's a good industry to be in. It's a high ROIC, return on invested capital industry, because you got high margins, de minimis capex, so that's high ROIC. And then you've got this convergence of growth rates between the three major players, Airbnb, Booking, and Expedia. But Expedia has far and away the lowest multiple. So that's kind of why I upgraded it, a month ago. Like I haven't had a buy on, my joke has been I haven't had a buy on Expedia this century. I picked it up in 1998. I started covering it then at its IPO. Now, that's not quite true. It's true, I picked it up then. I've had a buy in the past, but it's been several years. But I really like the setup into 2024. So this is kind of an outlier call. Expedia, the ticker's EXPE. And then third, Meta. And Meta, had a phenomenal year last year. The stock was up 200%. How could I possibly still like it? Well, it trades at 21, 22 times earnings. I think you're going to get close to 30% earnings growth this year. You've really got cost discipline, and the market is now rewarding companies that can sustain growth and cost discipline. The internet sector was really kind of, we'll give you growth at all costs. And at some point, the investors said no mas. They said no mas, no more of that to Meta at the end of 22 and spanked the stock. And then that's really what caused the management to change its tune. And I think it's permanent change. So if they're really going to do this, then you're going to have margin expansion with pretty good top line growth, kind of mid-teens. And you still got a couple of new growth catalysts. They still don't monetize Facebook Marketplace. And I guarantee you, a lot of people watching this, use Facebook Marketplace. It is an extremely popular asset that's under-monetized or almost unmonetized. The other one is this click-to-message ads. I mean, half of the advertisers to click-to-message ads are new to Meta, despite the fact that Facebook's been around for 15 years. They're new to it. And these are small developing businesses in emerging markets. And it's about 25% of Meta's revenue. So, this is it's a dynamic new ad format. It's indigenous to these markets. It works really well. And it's becoming material. So, yeah, I'll stick with Meta as our number 3 pick.
Great. Thanks, Mark. James, one thing I have to ask about, and we touched a little bit on Mark's side on the macro impact of rates and long duration assets. I mean, I think politics, regulatory issues here in the U.S. and geopolitics are on everybody's plate in the energy sector. Anything you'd like to say about those issues, how you kind of see things playing out and impacting your universe?
Sure. Maybe I'll start with the U.S. and the election cycle that we're in. There's a misguided view, I think, that the Biden administration has been bad for oil and gas. We're actually at peak production for both oil and natural gas that we've ever seen in the U.S. And so it's an industry that's not overly regulated. Yeah, they're not giving as many permits to drill in the Gulf of Mexico as we'd like. There is talk of an LNG moratorium on the Gulf Coast, which may or may not happen. I'm not convinced it's good for the country for that to happen, but they've actually been pretty positive, I would say, for oil and gas, just kind of staying out of the way, quite frankly. On the clean energy side, the IRA bill is transformational. So it's a $1.2 trillion bill, $369 billion. That's what the OMB scored it as for clean energy. You talk to the DOE, you talk to the White House, and they'll tell you that the $369 billion was the first number, but it's probably going to end up being several $1 trillion of capital coming into the country. And people are worried that if Biden's not reelected, maybe there's some rollback of the IRA. I'm not worried really at all about that. First off, clean energy is a bipartisan issue. It's not partisan. George W. Bush was the first guy who put in tax credits for solar, for rooftop solar. So this is something that everybody wants. And with the IRA, a lot of this manufacturing that's transitioning back to the U.S. is happening in red states, about 75%. And so why go after your own base? Plus, they're going to have boots on the ground and shovels in the ground as well in building these facilities if there is an administrative change next year. And at that point, you're not going to stop what's happening, this re-industrialization of the United States. Now, flip over to the Middle East, where we've got Iran's proxies getting into it with Israel, and we've got the U.S. and the U.K. trying to clean up the Red Sea. Let's be honest, we've got kind of a hot war situation where things could spiral. It takes one guy with one bad shot to cause a major incident and send oil prices much higher. Now, we think the situation right now is, somewhat contained, and nobody wants a war between the U.S. or NATO and Iran. And Iran certainly doesn't want that, but it could get worse before it gets better. So by the time we get to Las Vegas next month, it may be worse. I can't deny that, and it will cause oil prices to remain elevated. Good for the oil and gas industry producers, but also good for clean energy, because if oil and gas prices are up and clean energy prices are lower, people will consume more clean energy, and deployment of clean energy will accelerate.
Last question in the time we have, briefly to each of you. I know you're going to be joining us in Vegas. Any sneak peek, James, you'd like to share on what your major topics are going to be there?
Well, kind of as I mentioned, things could change in a month. So we could be talking about something totally different, but right now it's going to be, the title is Energy Transition or Energy Evolution with a big question mark at the end. So I think we'll lay out our view of, yes, massive deployment of renewables, big game changers with some of the government subsidies, big game changers on the technology side that are happening. But let's don't forget about that 81% of energy demand that comes from hydrocarbons or satisfied by hydrocarbons. Let's don't forget about the 7 billion people that are living energy poverty. And so I think we'll talk more about what we see over the next probably 50 years is the evolution before really a transition.
Got it. And same question to you, Mark.
We're going to see whether tech and growth stocks can continue to outperform between now and the next month. We're going to have most of the big tech names having reported, and expectation is they're going to be putting up good prints. If they don't, we're going to have to reassess whether we'll have to reassess why that happened and whether that's a temporary or a permanent issue. And if they do put up put up good prints. The question we're going to have, like you have with Netflix today, is can you chase them? Should you continue to buy them if they're going to, pop on good numbers? So we're going to have a lot of fundamental news between now and next month to work through.
Excellent. Well, Mark, James, thank you both so much for your insights, and thank you all for watching. If you do want to hear more from these Evercore ISI analysts, dozens of other top trading and investing experts, I strongly encourage you check out the Money Show Traders Expo Las Vegas details. They're in the description below. It's going to be at the Paris, Las Vegas from February 21st to 23rd. Gentlemen, thanks again for your time.
Thanks, Mike.
Great. Thanks, Mike.